All right, guys. So thanks for joining me. Nobody's a stranger here, so you know the format already. We're just going to be talking about what we're seeing in the marketplace right now. And let's just talk about that for a little bit. And then, of course, as usual, we ask each person to state how they go about forming their watch list, because, of course, that may change over time. So we'll start with you, Andre, and we'll go making the rounds just as how you joined. So, tell us what you're seeing right now, how you prepare your watch list, and then we just go around.
So yeah, thanks, Jeremy. Even again, everyone. In terms of how I prepare my watch list, I like to be, I guess, from a top-down approach. I like to be guided by the macroeconomic landscape or the area that I'm looking at. So with familiar territory being Jamaica, I like to look at the macro space and the companies that are set to thrive under the prevalent conditions. After that, companies operating in industries that I think are likely to perform well over the medium term. Um, I like to take a deep dive into those spaces, and then from there, when I start to look at our cherry pick specific companies, I like to assess the financial statements across the board. So in particular, for starters, I'd like to look at the profitability. I like to look at the cash flow. Ideally, companies that are cash flow positive or generate positive cash flow from the operating activities are ones that definitely find favorable. I also like to keep an eye out on the debt levels. This is pretty much, this varies from industry to industry, but I like to take note of what comprises the debt. So, for example, debt raised when interest rates were low and are now due for refinancing in a currently high interest rate environment, are probably the company is probably likely to encounter higher refinance costs. So things like that, the strength of the balance sheet, as I said, the profitability, and I also like to look at the management team as well as the outlook for the company itself. And pretty much in a nutshell, that's pretty much how I build out on my watch list. My watch list doesn't only comprise of companies that I'm looking to buy, but ones that recent developments are likely to cause a material change in terms of the application. So that's things I'd like to keep my eye on, and that will advise me in terms of my next action. Whether it be to buy more or to enter this position or to reduce this position or just exit the position altogether.
All right, cool. Thanks for that, Matthew.
Yeah, so for me, essentially, I just try to read a lot. So I try to read at least an article every day. So I look at Gleaner, Observer, Our Today, all the different news outlets, even some international news. So I just try to keep up with some amount of information, and then I try to say, okay, this information, how could it impact a listed company? So I'm like, okay, is this news good for the company? Is it bad for the company? Could it change my outlook on the company? I also try to look at sometimes companies that aren't very popular. So maybe there's an issue going on in the company. The stock price hasn't really performed for a long time, and people have been, I guess, been turned off from the company. But then I see something that if there's an issue that could be fixed, I try to track it and say, okay, how can this issue be fixed? And then I could use that possibly as a chance to enter. If I think that that issue can be fixed, I try to look at something that could be happening maybe even 5-10 years down the line, and that could benefit that company heavily. There's something could change about the company or change about the industry. That's it. So it really is just trying to read a lot and trying to use my knowledge, try to read books and things like that, and try to learn from other investors.
All right, cool. Thanks for that, David.
So Andre kind of highlighted how I've had to adapt or adjust my kind of stance. So the top-down approach works pretty well right now, alongside understanding that own company's fundamental perspective. So he mentioned the debt position, he mentioned the prospects for growth, and so forth. And why does this matter? So we saw today whereby US inflation was what they would describe as hot. And we saw where their corresponding stock market declined, and more persons are expecting, that the US Federal Reserve, which is their central bank, to less likely cut rates any further, or the number of hikes that the number of cuts that were expected this year has actually gone down. So the reason I mentioned all of that is companies that are potentially, saying, hey, we bought this new asset, it's been a great cash flow, but we wanted to refinance at cheaper rates. No, they're going to have to be looking at different ways to finance some of these deals or opportunities. And based on how the current environment set up, I've become a lot more circumspect, looking at things like the stock's liquidity, how concentrated the ownership is. So, for example, like a product business solutions, like the directors, executives, and top 10 shareholders have about 99% of the stock, which means there's a very small free float in the first place. Then, you know, you have to also consider other things such as, who are potential major shareholders and what implications exist if the stock price falls below a particular point. So, whereas in the US, we might know potentially the short interest or how leveraged a stock is. We're doing that kind of dynamic here in Jamaica in the same breath. But basically, what I'm pointing out is some stocks, if they trade with a particular price, usually see a rebound back to a particular minor range by the end of the month or in a shorter period of time, just because it has great implications if the price stays depressed for some time. So these kind of little notes help, the viewers to understand my perspective, and also, just how even Matthew or Andre's perspectives, impact how you approach or analyze stocks in this current environment or any environment, to say the least.
Yeah. For me, I guess specifically no. I'm just looking at opportunities for income. So I'm looking at companies. So similar to Andre, I'm looking at cash, but I'm also looking at dividend history, right? Because I don't have the same time. Well, one, I don't have the same time, but I also don't see the same activity, something that we've been talking about for the last year and a half. And so, because I mean, there are always opportunities in every market for cap gains, regardless if there's a market crash or recession or anything like that. But I'm looking at more, I see where investors may favor those companies that are paying out cash flow through dividends. And I'm looking for ones with an attractive yield, of course, within the companies that I will invest in. And there are two known companies that I will not look at, no matter if they're double or triple their dividend yield. And we all know who those companies are. And that's for moral and faith-based reasons, right? So then I rule out those two, and then I'm looking at everybody else, and I'm just seeing either a potential for a really good dividend from a company that maybe I've been paying consistently. I know they're about to up that because they're saving a bunch of cash, and one company comes to mind. Or you may have a company that stopped paying dividends or stopped paying as attractive a dividend since the pandemic, and maybe they're looking to recover. I know I'm not talking about NCB here. And just kind of looking to see finally what the narrative is. Because I really believe that as much as investors speak about fundamentals, speak about all the things that are nice and warm and fuzzy, the narrative is what will typically make an undervalued stock go to reasonably valued, go to overvalued, and even past that, right? That narrative is a very big move of the stock price. And so I'm looking for two things right now. Now I am paying attention to what has been happening in terms of the economy, interest rates, etc. Because I'm looking at the financial industry as a signal to see when we're going to actually get back to 2018, 2019 levels. I think when we start seeing the financial companies move, that's when we're going to see the rest of the market go back to levels that maybe we were seeing at that point. And what I'm hoping to do by then is have some really nice positions in companies that I think are undervalued now for many reasons, right? So that's kind of how I do it. I have less than 10 stocks in my portfolio right now, and I'm looking to just add to those positions over time. It hasn't changed much, I'll tell you. In the last year and a half, 2 years, I've been watching the same set of stocks. Only one or two may add to it within the year, and we've seen that, right? It's really the same set of companies, in my opinion, that are doing okay. Meaning, we may see some go up for a little bit and they go right back to where they were before. So I think this climate, especially the high interest rate, etc., favors certain companies, and so I don't think that will change until the climate that we're investing in change. So hopefully that makes sense.